get back on with your day. So I'll hand over to James. Thank you.
Yeah, thank you, Penny, and good morning, everyone. As Penny said, my name is James Chaplin. I'm the Senior Manager of the Curve Trading team here at EDF in the UK. Now, as Penny said as well, just a reminder, if you do have any questions going through, feel free to pop them in the chat. We'll try to answer as many as possible at the end of the webinar. I'll try to cover as much information as possible, but I'm sure there's bits which I'll miss out. So if you do want a bit more clarity on bits that aren't in the presentation, feel free to ask a question and we'll try to get around to that. Now, layout for today, essentially the same as the previous webinar. So I'll touch on kind of what's happened in the market, what's changed prices. Now, contrary to probably a few people's beliefs before, thinking it was going to be a more calm and more kind of dull market so far this year, it's been quite the opposite. We've had lots of volatility, particularly over the last few months, really driven by geopolitics. So we're kind of look at the market price reaction, kind of where we are now, and then touch on kind of the fundamentals before summarizing at the end. So if I start off by looking at UK power prices, now this is a chart of a few of the forward contracts, so September out to summer 25, and looking at the price movements over the last year, so from beginning of August last year. Now, key things to note is obviously we are significantly below where we were about this time last year. If we rolled back the chart an extra year or two, and you would have seen the energy prices where we got up to several £100 a megawatt hour, we are still significantly below those levels, but still higher than your long run average of 5 years ago or so. Now, obviously this chart doesn't quite give the detail we want to talk about in this presentation. So if I roll on to a bit more granular chart here, so this is actual intraday traded prices of the winter UK gas contract coming from the start of January this year. Now, if we cast our mind back to kind of the Q1 time, you would have seen the market obviously very bearish, kind of hitting a low in kind of the mid to back end of February. Now we had, I think it was probably the mildest February on record across Europe, extreme mild temperatures, very windy as well. Any reliance on gas storage that we thought we needed was far below that. So actually we drew a lot less than we needed. We actually ended winter at record high EU gas levels. So obviously that led to a lot of bearishness in the market, thinking that we're fine for the supply side. And we actually thought at that time we're going to have quite a large oversupply for summer of between 100 to 150 terawatt hours, which is quite significant. If we roll into the start of summer, now the kind of the bearishness, low prices continued up until about early April. And then prices ticked up. Now we did get actually a bit of a cold spell at the back end of April, which is obviously quite late in the year. Did hit some of the storage injections. I think we actually flipped to withdrawals for a week or two around that time. But we also had geopolitics, and this kind of spans kind of from April through to May here. Russia targeting energy infrastructure in Ukraine, and obviously the escalation in the Israel-Iran conflict as well. Now the fear there was that we could have supply cut off from the Strait of Hormuz, which supplies just over 20% of the global LNG supply worldwide. So significant supply fears at that time. And I think a bit later on, probably more around the May time, we also had the threat that OMV would be forced, so the Austrian kind of gas player would be forced to stop taking offput from the Russian pipeline as well, coming through Ukraine. So lots of kind of moving parts on the geopolitical timeframe there, driving up prices. Roughly at the same time as well on the fundamental side, we did actually have a rise in LNG competition. So although we needed a bit of LNG to actually leave kind of the European basin and kind of go elsewhere to balance our market, we also saw higher demand in Asia as well. So hot temperatures, particularly in China, Japan, South Korea, and India, kind of main LNG demand hubs, drew a lot of LNG, particularly US LNG, away from Europe and towards their basins. We also had several supply outages around that time of year as well. So Freeport LNG, which is based in the US, they've been plagued by outages for several years now, but particularly this year they had a big outage at the beginning of the year, and again more recently as well. We've also had outages in Bintulu in Malaysia and several plants in Australia as well. So that hasn't helped kind of the sentiment in the market, thinking that supply is stable and secure. And I think this is just kind of the world we're in now, where we don't have that stable pipeline supply where we know it's going to come to us. It's all on a global level. You have to compete for the LNG to come to your basin. And when these LNG plants go on outage, obviously they are significant supply sources, and it can last for quite a period of time, as we've seen in Freeport. Now, more recently, over the last 3-4 weeks or so, we have had again increased geopolitical risk. So first of all, we had escalation in the Middle East after the assassination of the Hamas leader in Tehran. And then a week or two later, we had the Ukraine incursion into Russia. So Ukraine essentially took over the Sudza metering point, which flows around 0.4 terawatt-hours per day into Europe as well. So again, we I suppose essentially reduced all of that overhang balance for this summer from 150 terawatt-hours down to a very finely balanced market. You add in some of these extra supply risks at the back end and thoughts of, what if we get a cold winter again? You can see obviously the volatility has kind of jumped back into the market on the fear of what could happen going forward. Now, to touch on fundamentals, so the first one here is looking at French nuclear output, and overall, this is a fantastic story, really. So on this chart is just French nuclear output per year. So we've got the range from 2016 to 21 and the several years since. Now, the black line here showing 2022, you can see we actually had very low nuclear output all through summer and kind of going into winter. That's when we thought we were going to have some big power scarcity problems, rolling blackouts across Europe, and coincided with the gas crisis as well. We're not in that situation this time around. You can see that red line, which is 2024, very good French nuclear output, and French prices over the summer so far, or over the whole year, have been particularly low. Now, we don't have the forecast on this chart, but the forecast to the end of the year, again, is very good. EDF Group have said obviously output targets are on track. So essentially power scarcity risks are not in the market at the moment. Obviously anything can happen, but we're looking pretty good on that front for this winter, and particularly for the Q4 element. And we have actually seen that reflect in the clean spark spread, so the kind of marker of power scarcity, where clean sparks essentially for the UK right through the horizon are all negative, and some of them quite deeply negative. Next, European gas storage, and again, this chart looks fairly comfortable in a fundamental point of view. So just to highlight, this is showing European gas stock levels at a point in time of the year, running from the 1st of April, so when summer starts through winter. Now, typically, 1st of April start of summer, so you expect roughly around that time is when you start injecting into storage, so you start filling up storage, and then around kind of late October, early November time, you'll start withdrawing as gas demand ramps up with heating demand. Now, what you can see towards the left-hand side of the chart is we actually ended winter at record levels. I think at one point we were 65 terawatt-hours above last year. And that's kind of when we're talking about the mass oversupply or potential oversupply for this summer. We roll forward to now with that LNG kind of turning away to Asia. We have closed that gap. We're actually running around 10 terawatt-hours less than last year, obviously flipping from that positive 65 terawatt-hours. So a lot more balanced market, but if we take, I suppose, a step back, if you think we lost that kind of 75 terawatt-hour difference there, we're still very good. We've actually just hit a couple of days ago 90% full in European gas storage levels, well ahead of the target, and we're looking to get pretty much full by early winter. And I suppose if supply remains quite strong or stable at least, and we do get a mild start to winter, so a mild October, which is in the forecast at the moment, we should get to pretty much 100% and potentially need floating LNG storage to push back a bit of supply into those kind of colder months there. Next on European LNG imports, now not such a rosy picture here. Now this is data showing European LNG imports by month and by source, so you can kind of see where those cargoes are coming from. And going back to January 22, I think really what we want to focus on here is what's happened so far this year. So the right-hand side of the chart, and generally you can see a trend line down. LNG imports have been falling off quite drastically over the last few months, and a bit earlier than expected. Typically, we don't need as much gas in summer, and those LNG tankers, along with outages, also the tankers turn away to Asia where they have higher air conditioning demand. But is a lot more kind of turning around than expected. So you can see record kind of lows over the last few years for July and August. Now, the fear, I suppose, here in the market is, are we going to get this supply to come back to us when our demand upticks? And that will be kind of from November or so onwards. Our opinion is, it should be fine. Typically, Asian demand ramps down in kind of those shoulder months, so you should start to see those cargoes turning around to us. But definitely one to watch out for in the market. But again, you can clearly see one of the downtrends here and why the market has tightened quite significantly over the last few months. And just sticking on LNG, so what we're seeing here is actually a map of the world. The little orange dots are live LNG cargoes. Took the snap about a couple of days ago. And you can roughly see the supply routes from the kind of three main suppliers. So the US, particularly from kind of the Texas region, you can see ships are coming out of here and heading in one or two directions. They're heading either towards Europe or they're heading around the Horn of Africa towards Asia. You also have Qatar, which is shipping through the Strait of Hormuz, mainly towards Asia. Some cargoes, again, coming around the Horn of Africa. Now, they are coming that route because obviously the Suez Canal and the Red Sea is still under threat from the Houthi kind of missile strikes and cargoes. So they're avoiding that still. And then lastly, you have Australia in the bottom right. Again, too costly and time consuming to ship to Europe, so that they ship particularly up to Asia. Now, I think I might have cut it slightly off the top of the map, but you have Yamal LNG in Russia. Actually, as it's summer, their waterway to the east is not frozen over. They're sending ships both to Europe and round kind of the top right towards China and Japan as well. Now, one of the things that I just wanted to show on this chart is a particular LNG tanker we've been tracking over the last week or two. And it's actually heading towards France Montoir at the moment, but as you can see, it filled up in the US, headed on its route towards Asia around the Horn of Africa, and then it stopped for a few days and then changed its direction and is now signaling Europe. Now, this coincided with the price spike. So what we saw in the chart, where we had Ukraine go into Russia, cause about a 15-20% spike in prices. That meant the LNG tanker decided actually it's more profitable to ship now to Europe instead of going to Asia. So you can see that kind of supply side response due to European high prices. And this is kind of obviously what we have to watch out for in kind of this new world where LNG is the marginal source. Whoever's the highest bidder will essentially get that supply. So this is kind of one example of a tanker turning around, heading to Asia, now heading towards Europe. Now, on the recent, I suppose, geopolitics, first we have Middle East. So this happened, I think, 3-4 weeks ago. The assassination of the Hamas political leader obviously increased the risk of escalation in the region. Now, the two main areas that we see kind of impacting European commodity prices. First is the Strait of Hormuz, which is seen kind of on the chart below, where all those kind of orange dots, the LNG cargoes, are filtering through. The small gap kind of bordering around there. Around 21% of global LNG supply goes through here. So if that was to be cut off, you're talking essentially another gas crisis. The chance of that is extremely low. So we don't think that's really impacting the market at the moment, and you can probably see it would impact oil as well. Oil's not really taken too much notice of this escalation. The one that I suppose is higher risk is Israeli gas production itself. So they produce roughly around 240 terawatt-hours a year. So it's actually quite significant supply. If this was targeted in any retaliation strikes by Iran, obviously that takes a lot of supply out to the global market. Israel itself would have to import LNG, but also Israel exports, I think it's around 50% or just under 50% of its gas to two nations, Jordan and Egypt. Again, those countries would have to rely more on the LNG market as well. So again, sucking some of that potential extra supply away from Europe towards those nations. Again, we think the risk of this is fairly low, but again, it's a risk the market is just going to have to be conscious of and price into prices at the moment. Secondly, and I suppose the one that is of more concern or more immediate concern to the market is the latest developments in Russia and Ukraine. So kind of out of the blue, the Ukrainian offensive into the Kursk region significantly spiked prices a couple of weeks ago, and that's solely because they've taken over the Sudza metering point. So actually on kind of the map of the area in kind of the pink and purple, right where that kind of crosses in the middle, roughly, probably a bit closer to the border, that's where the metering station is, so very close to the border there. And the image on the right is what came out about a week later after the incursion of, you can see the admin facility, and one of kind of the metering points has seemingly been targeted and blown up. Now, gas is still flowing through the pipeline, but I think both parties, Ukraine and Russia, have voiced that they are keen to keep flows continuing. But even so, it remains a risk of a wayward shell or kind of some accidental damage. Now, this pipeline we were expecting to stop flowing at the end of this year anyway. The Ukraine-Russia gas transit agreement ends at the end of this year. So really, it's only impacting supply out until the end of December, which at the time was around 60 terawatt-hours. It's probably a bit less now as time has gone on a couple of weeks, so probably around 56, 55 terawatt-hours of supply loss. But with the market tightening up significantly over the last few months, that loss or potential loss of supply would mean we have a bit of a hole to fill with LNG or demand reduction. So just to summarize on some points I probably haven't talked around in the presentation yet. So on the weather front, looking at kind of longer term weather forecasts, we are actually looking that September and October are going to be particularly warm. Now, I would caution long-term weather forecasts can be quite inaccurate, but this is in the forecast at the moment, and I suppose might be more typical from an El Nino global weather pattern. If that happens in October, that will obviously help out European gas balances quite a lot. October is quite a kind of a trendsetter for winter. If you do get an early cold start to winter, you have to start withdrawing on storages quite early. If you get mild, which we're expecting at the moment, you can pump a little bit more into storage. We are also expecting a shift in global patterns, as I said, from El Nino to La Nina. So although we might get a milder start to winter, particularly over October, we do risk potential colder weather a bit later on, either in kind of November, December, or particularly really Q1, and that could be across Europe, and it could be across Asia as well. So again, uncertain, but something to be mindful of and watch out for. Geopolitical factors, we already talked around the Middle East escalation threatening Israeli gas supply. I think the risk of this is being slowly priced out in the market, as there's been no retaliation yet, but it seems to be hovering around, so we'll have to keep an eye on that over the next few weeks and months. And again, I think what's more immediate concern is the Ukrainian incursion into Russia, so that roughly 0.42 terawatt-hours per day. Although not drastic amounts of supply, it will impact balances quite a bit in Europe, and at least until we are confident of this extra global supply ramping up over the next few years. But this winter we're still kind of at a quite, I suppose, tight global market. On the supply side and storage front, as I said, we have had some rolling outages impacting supply in the US, Malaysia and Australia over this summer. Supply at the moment is actually very good. I think we're actually at the highest point for this time of year. As I think Gorgon facility in Australia has come back from outage, Bintulu's flowing at record rates as well. I suppose one thing to caution is the US hurricane season is still to be kind of watched. I think over the next 7 days, we're not expecting any cyclones to form, as there's a bit of dust over the ocean, kind of stopping that. in early September, there's higher risk of these storms forming, and with the very warm oceans at the moment in that region, that could ramp up. So that could impact supply from the US if it kind of hits more directly the Gulf of Mexico, kind of later September and into October. Also upcoming, I think pretty much starting the last few days of this month and running particularly all of September, or mainly all of September, is heavy Norwegian maintenance as well. So up to 150 MCM per day plus on outage. And as always with these big outage periods, there's a risk of extensions as well, like we saw earlier this summer. So the market, as always, will be mindful of that. But despite this, we are at record or near record rates of gas storage. We're already just over 90% full. And with potential or hopes of warm weather at the start of October, we should get that to 100% full before colder weather starts in November onwards. And lastly, on the global demand front, we've seen so far this summer, and we would be expecting over the next few weeks as well before that tails off. So that's obviously driven higher air conditioning demand there, and therefore higher LNG demand. That should taper off before colder weather a bit later in the year. But also we have seen sluggish industry demand across Europe, so that's kept demand quite low in Europe, and economic growth in China has been a bit slower than expected. So again, slower kind of demand ramp up than we'd expect from that side as well. That is all from me. Hopefully covers most things people were expecting to hear. But yeah, please, if you have any questions, feel free to pop in the chat now, and we'll try to answer as many as possible.
Thanks, James. We do have a question that's come in, so I'll kick off straight away. So with most expecting SUSA to stop flowing at the end of this year, why do you think the curve has risen so significantly in periods where we weren't anticipating receiving the gas?
So gas, it's all linked with storage, right? So if you lose out on 60 terawatt hours in the rest of this year, you're gonna then have to utilize storage. It kind of impacts right down the curve, and I suppose any kind of halt in supply or kind of targeting of the pipeline removes any hope that I know another kind of bypassing deal could get over the line. We know Naftogaz, kind of the Ukrainian company, was trying to work with a solution, potentially using Azerbaijan to kind of flow gas through that pipeline as well. But I think it's more the point that you lose gas now. You have to rely more on storage in Q4. That's going to tighten balances again in Q1 and so forth. So it just kind of tightens the next few years.
Okay, thanks, James. Do we have any other questions? I haven't seen any come through, so perhaps you've covered everything. Just refresh. Oh, no, we've got another one come through. Brilliant. So from a UK perspective, is Rough now fully operational?
It's not fully operational. I don't know actually how much it's being utilized, but it's kind of partial operational. And I think in future, I think their plans are still to use it as kind of a hydrogen storage facility. But in general, kind of European gas storage is quite limited versus kind of how much capacity Europe has. And through winter, we typically turn to net importers of gas on the interconnectors we have to continental Europe from typically like November onwards. So we don't really have kind of that supply side from storage ourselves to rely on. We have MRS, which can handle kind of short cold snaps, but obviously they have to churn the site quite a bit.
Okay, thanks, James. Did anyone have any other questions?
I suppose just whilst we're waiting for questions to come in, I know I haven't touched on kind of US politics at all. I know that was one of the questions last time. I think our deduction from US politics and kind of who the next president, does that impact commodity markets at all? I think in the short term, or even in the next year or so, the answer is no. So any kind of policy changes would take a little while to come into force. I suppose the major one would be policy change on new build LNG facilities in the US, but that would be impacting more at the back end of the decade anyway. So nothing to be too concerned around in the immediate term. I think just something to keep an eye on. The other, I suppose, impact there would be potential sanctions on other nations and kind of relationships with Russia, Ukraine, kind of Iran, Israel. Again, we don't think anything in the short term, but yeah, potentially one to watch out for a bit later this year and next year.
Thanks, James. Actually, we had a question come in on the back of that. So, do you worry about US protectionism?
So I mean, again, not in the short term. I don't think it's anything we need to kind of worry about in the market over the next couple of years at least.
Okay, we've had another question come through. So, is there any insight on whether increased UK windfall taxes would reduce North Sea output in the near term?
That's a good question. Probably not something I'm too clued up on, to be honest. Again, I don't think there'd be any kind of short-term impact. But yeah, I'd have to do a bit more research on that myself.
We did have a webinar last week actually with our corporate affairs team looking at the new UK government, and there was a few things about windfall tax in there. I don't know if anybody wanted to go and catch up on that. It's on our Talk Power page. I think that might be all the questions. So it's great that yeah, James, thank you for giving us such an insightful webinar and covering everything. And we really like doing these webinars, but just to make sure we are delivering kind of the content that's working for our audience, I have just dropped a feedback survey in the chat if anyone has time just to go in there and give us a little bit of feedback. And then yeah, there's on the screen just our usual details to get in touch if you do have any burning questions that come in after, or you want to follow us on our LinkedIn page where we do try and share a lot anyway, then please do. And then I guess the last page is just to give you a little look at what we've got coming up in the rest of the Talk Power programme. So we've got Monitor on non-energy costs on the 12th of September. And then, yeah, we've got another Power Market with James later on this year and another Monitor. And we also have quite a few recordings on there, recent ones we've done, like I say, around the UK government, energy policies and that sort of thing. So, yeah, do head to the Talk Power page and see if there's anything there that can help you. So thank you, James. Thank you for your time. Thanks, everybody, for joining us.